Welcome to week number 2 for 5150, Accounting for Decision Making. We're going to look at a couple of things today. We're going to look at the revenue recognition case, and I'll talk a little bit about it so you'll have some idea what you need to write about in your paper. And also we'll look at the first chapter, maybe first 2 chapters of this first section on financial accounting. Now, a lot of this I've already talked about in the first video, Accounting Made Simple, as well as that PDF on the principles, those 5 key principles and what the 5 are: revenue recognition, matching, materiality, conservatism, consistency, not necessarily in that order. Those are the 5, and of course that PDF on how to understand debits and credits, T accounts, and so forth. So we'll be hitting it again here in these first couple of chapters, but repetition is good. But let's go ahead and look at this first case, waste management, expense recognition principle. It is out there on your D2L content. So let me see if I can find that here and share it. There we go. All right. Let me see if I can move that over to the other screen. So it looks like I'm looking at you instead of away from you. All right, so you should be able to see that. It's about WorldCom, the revenue recognition principle. You can read that synopsis there. It's going back almost 18 years, well, more than 18 years ago now. A lot of issues back during the dot-com bubble that burst. Of course, that was, most of you were probably really young then, and what had happened in the build up into 2000, you had the stock market just taking off because of all this build out into 2000 and what was anticipated there. And there was a lot of pressure because to make the stock price go up, you had to have earnings that supports that, because earnings drives the stock market over the long term. Short term, other things can influence the stock market, but long term, it's all about earnings per share. Well, how do you get earnings per share? By increasing your revenue or decreasing your expenses. But WorldCom, like several companies during that time period, Enron is another one, started inflating their revenue. In WorldCom's case, started recording revenue that was not justifiable. There was no supporting evidence to support the revenue that they were booking. If you read down through this, of course, some people, it looks like, went to jail, didn't they? Prison terms. If you read down through this, it first starts out about talking about hitting the numbers. That's when Wall Street, their earnings per share that they record and report on once a quarter, there's always guidance going forward, at least there was at the time, about what the future holds. And you can read there that they were talking about 12 to 15% revenue growth. Well, that's a pretty good size revenue growth projection. And anytime you got 12 to 15% projection for the next year, the stock price should go up 12 to 15%. That's pretty much the bottom line on that. And so they really didn't have the sales to support that. And because of that, it's a very basic case. I mean, oftentimes we think these schemes are really detailed and scams that require a lot of people involved and so forth. But usually these schemes are pretty simple. You just get a few people decide they want to so-called cook the books and hit the numbers, and next thing you know, you're in a situation that is treacherous. And in fact, once you start down that slippery slope, it's very difficult to turn back. Because when you start booking revenue that you have no support for, the problem is that that's going to show up, that revenue has to show up as accounts receivable at some point, or cash. And either your accounts receivable is going to go out of sight from trying to hit these numbers. And I think, let's see, I think I actually showed the wrong. Yeah, I put waste management up there at the beginning. Now, this is WorldCom. But as you can read down through this, I'll point out a couple of things. First of all, this concept about hitting the numbers. Second page, if you look down here at the monthly revenue report and the corporate unallocated schedule. Well, that's a great term, corporate unallocated schedule. What it says here that the MonRev monthly revenue, because they were closing the books monthly, included dozens of spreadsheets detailing revenue data from all the company's channels and segments. However, the full monthly revenue also contained the corporate unallocated schedule. An attachment detailing adjustments made to it at the corporate level and generally not derived from operating activities. Operating activities. So here they're just at the top line, even though you've got your key business segments that are doing the right thing, hopefully, bubbling up to the top when the revenues fell short of what they were supposed to be. They pretty much booked the difference between what was budgeted for revenue and what the actuals were. Well, that's a good way to make sure you don't have any variances. Well, and they got into a situation there, well, this is one-time adjustments, but once it's out there, unless it's going to be written off in the future, you got a real problem. So if you read through there, and it's a very short case, only like 3 or 4 pages, but it talks there, especially on page 9 there at the top, look what it says there. In quarter-ending months, however, top-side adjusting journal entries are often very large or allegedly made during the quarterly closing process in order to hit revenue growth targets. Investigators later found notes made by senior executives that calculate the difference between actual and target, actual and budget. If you don't hit the budget, then make a journal entry for it. Worry about it later. But that just begins a snowball. It just gets worse and worse and worse in trying to cover this shortfall in revenue when their market had been saturated and they weren't growing. In fact, you read this voicemail that CFO Sullivan left to Bernie Evers talking about this monthly revenue just keeps getting worse and worse. The company, latest copy that you and I have already has accounting fluff in it. All one-time stuff or junk that's already in the numbers. The numbers being, off as far as they are, I didn't think this stuff was already in here. We're going to dig ourselves in the huge hole because year-to-date it's disguising what's going on, the recurring service side of the business. So he obviously, the CFO knew it was an issue and he's telling the CEO. And I can't remember if they both went to jail or just Evers. Seems like both of them did. Several executives. Yep. Guilty to charges of fraud, were sentenced to prison terms, including CFO Scott Sullivan, 5 years, Controller David Myers, 1 year and 1 day. Doesn't talk about Evers, but I know he went as well. Oh, there it is. Convicted of fraud in 2005, CEO was to receive 25 years. Well, 5's not as bad as 25, and 1's not as bad as 5, but still, we're talking about prison time for cooking the books. So if we're going down to the bottom, there's really just a couple of questions. The rest of them I marked off because they were auditing related questions. What I want you to do there is talk about the revenue recognition principle. And it was briefly discussed or listed in the Accounting Made Simple, but we're going to look as well today in this MBA. I think it's on page 53 and 54, gives a more detail, but feel free to do some research on that yourself, because the revenue recognition changed here in the last couple of years. It changed in the sense that there's what's called performance obligations, but in essence, the whole revenue recognition process is not that much different from what it used to be. These performance obligations have to do with when was the actual service or goods performed, and this being WorldCom obviously has to do with cell phones and so forth, and service, which is a little bit different versus building product and shipping that to someone, or performing a service, which I guess you could say this is probably service oriented since it's WorldCom, one of those long distance and cell phone providers. I think they were in the cell phones at the time, I don't recall. But when have these performance obligations been met? And you can do some research on that. And I would encourage you to do that, this is an MBA accounting class. You think, well, what's this got to do with me as a future general manager? You've got to understand these principles that are involved. Now, Bernie Evers, whether he knew what was going on or not, if he didn't think it was any big deal to do what he did, the CFOs and the controller obviously know that this goes against GAAP and what's required for revenue recognition. It has to be based on supporting documentation of when the title has transferred, the service has been performed, the goods have been delivered, in order to book that as revenue. Once you book your revenue, then you match your expenses with that. And that's what we'll look at on the waste management, which I put up there previously, put the wrong one. But the waste management case here, which incidentally is 1.1, you know, the one we're looking at here is 1.2. I'm not sure why to me, they've got it reversed, because the revenue recognition comes first, because you match your expenses with the revenues that you have booked. But I want you to do some research on that and write about it in your first paper. And you can look at the syllabus and what the requirements are for length, the number of words. It's about 5 pages, but you need to follow the number of words and have 1-inch margins and so forth. Follow APA 6th edition if you have references, and when you cite those references. If you're unsure how to do that, I would encourage you to click on my dissertation that's out there, because it has about every type of reference you could have and how you should cite that in your paper. So it's a good learning experience. You at the master's level need to know how to do research and write scholarly and be able to really give some answers to these 2 questions, which are really straightforward. So talk about revenue recognition. The second part there, provide one specific example of how WorldCom violated revenue recognition. You can, or you don't necessarily have to answer the second part of this with a journal entry. If you want to, you can, but it's more about what's an example of how they violated the revenue recognition principle based on what you've read there. And like I said, some things really jump out from the page to you. And I just want to follow up with talking about revenue recognition. We had, when I was at Exide, we also manufactured 30,000 batteries a day for the automotive industry. And when we did that, probably half of our business went to Toyota. What I was saying, relative to Exide and shipping batteries, we had a very unique revenue recognition issue back many years ago. And the issue was that as we got closer and closer to the end of each month, in order to hit the number of batteries that were in our shipping log, now these weren't made up batteries, these batteries actually, these orders existed, but these orders would be pulled forward and you would accelerate the shipping at the end of every month. Well, that was common. Our external auditors, PwC, knew that. Internal audit knew it. But the issue was that we were shipping out through trucks, with half of our business going to Toyota and Nissan, they would come and pick up the batteries with their own trucks. The other half, we would ship out on common carrier. So the title passed on to Toyota and Nissan as soon as it left our docks. So it was pretty clear that when you ship confirmed batteries off of your books, off your racks, ship confirmed off your books from inventory, the cost of goods sold, you booked the revenue at that time and everything was fine because the title passed. The performance obligation had been met with Toyota and Nissan because they took control, because they're a just-in-time type company. They took control of the battery shipments from the time it left our docks. But the others, like Walmart, O'Reilly, Advance Auto, Walmart, places like that, we ship common carrier to their warehouses. Well, sometimes it would go down here to Greenville to Sam's warehouse, which the same day that you would ship the batteries off your books, even though it didn't actually, it wasn't theirs until they took delivery at their warehouse. When it was in transit, Exide still owned it. The performance obligation had not been met, had not been delivered. If it was close by, it's no big deal. But what if you're shipping to West Palm Beach, Florida, or somewhere up in Maine or New Hampshire and so forth? In that case, it might be 2 days, maybe 3 days before those batteries reach the destination. And so then you've got an issue that you booked the revenue at Exide, but in reality, that revenue shouldn't be recognized until a day or 2 or 3 later. Well, PwC helped us because it was impossible to go through all the bills of lading to see when these were actually received 3 days after in order to, since you had an expedited closing cycle. They decided that any battery shipped the last 3 days of the month, we only got 50% credit. So 50% of those batteries are the ones going to Walmart, again, AutoZone, O'Reilly's, not the Nissan and Toyota, just the 50% of the batteries going to those particular locations that were aftermarket. That's what I'm trying to say, aftermarket sellers. 50% of those in the last 3 days of the month can be booked as accrual until the next month. So we had an automated system doing that for us. Well, we had to make a manual journal entry that reversed 50% of the revenue in the last 3 days of the month from our facility. And so that's an example of performance obligations for a manufacturer. And here again, what we're talking about with WorldCom is a little bit different. But keep that in mind about performance obligations and some of the stuff going on there. The internal control environment, that's a good term, internal control environment. If you want to do a search on that, internal control environment. And they didn't have any, did they? If you've got people at the top line making, or at the top making decisions that the people at the lower level didn't know, just in order to hit these numbers, you can see how this was fraudulent and people went to jail for it. So that's sort of a kickoff for that revenue recognition. And the next meeting, we'll look at the expense recognition from waste management. But we'll do that in the next video. Also, I'm going to go ahead and talk a little bit about this particular text and in the first couple of chapters here. What you see here, again, they're starting out here with financial accounting. That is part 1. So the first 8 chapters are about financial accounting. And this is a little bit more detailed than what you had in the Accounting Made Simple book that you've already read and understand. I think what jumps out to me is the very first line here on the introduction. What does it say here? Accounting is the language of business. It is. It truly is. And that's what's important for you as future managers, maybe controllers, general managers, presidents, directors. You need to understand the language of business, and that is accounting. If you look at the financial accounting basics in chapter 1, it talks about the real world, key concepts, the objectives of financial accounting. Because in this chapter, they're going to talk a little bit about managerial accounting also. So when you hear financial accounting, you hear managerial accounting. Financial accounting is for external reporting. It's for external reporting to your shareholders, to your bankers, your creditors, your bondholders, and so forth. But when we get into the managerial side of this, which is part 2, starting on page 125, there's only 2 chapters there, but managerial accounting has to do with internal accounting and how to use this accounting information to make decisions. Things like cost, volume, profit analysis, cost accounting, which is still, cost accounting is still under GAAP, but these first 8 chapters is about the fundamentals of financial accounting, financial reporting. I encourage you to read this chapter. It will help you in writing some of these papers that you are doing. If you look at page 10, it talks about the relationship again of that term, right? General accepted accounting principles, GAAP, right there in the center. That's very important. You can see the relationship there, FASB, Financial Accounting Standards Board, the International Accounting Standards Board, who has the IFRS, all the professional organizations involved, the IMA, the AICPA, the SEC, which is all about public reporting, and of course Congress and the laws that come out. Principles and concepts, again, it goes into the detail here of your balance sheet, your income statement, statement of changes in equity, statement of cash flows. I've talked about three, and the two most important are your income statement and the balance sheet. Those are the ones that have your account, all your account titles. They mentioned on page 13 and 14 and 15, some of those principles that was in that PDF. Now, every time you look at this, you're going to see a different list, right? Accrual accounting, revenue recognition on page 14, matching principle. Accrual accounting is what you do with revenue recognition and matching. They're on page 14, right? Accrual accounting. Revenue recognition and matching. Conservatism, full disclosure. So you should get a pretty good understanding of what's going on with those principles there when you're forming your answers in your papers in this class. They talk about types of audits on page 16 and 17. Financial audits, operational audits, department reviews, IS audits, investigative audits like what WorldCom had. The financial audits and operational audits are the most common. And you can test yourself there at the back of each of these chapters, and the answers are actually in the back of the text, I believe. They're back there. Yep. So the answers are back in the back of the book. So make sure with each of these chapters you understand what is going on. And I will be able to tell if you understand the text by how you formulate your answers for, or your papers for these various cases that we were looking at. All right, and then chapter 2 is the accounting process and cycle. I like how it starts each of these chapters with in the real world, key concepts, because in the real world there's a lot of stuff going on there that's you don't necessarily get covered in college, and that's things like expense reports and purchasing reports, three-way match, accounts payable, payroll. Very important. Page 22, the accounting equation, assets equals liabilities plus equity. The accounting cycle that we have of recording transactions, one of the key things is knowing when to record a transaction. Or is it something that we just need to disclose? Or is it remote and you don't have to do anything? But once you decide to journalize a transaction on page 26, you're going to make it, when you journalize something, that means you're going to record a journal entry. That means you're going to impact your balance sheet and or your income statement. Those are the two primary statements. And then when you journalize that, then it gets posted to the ledger on page 27 again, all right, or general ledger, journal to the general ledger. So we know what our balances are. Preparing the financial statements, closing the books, the process. You should understand as anyone in business what the general process is. And so then again on page 35 and 36, or I guess just 35, 5 simple questions there to make sure you understand. Again, the answers are in the back of the text. So I guess we'll just stop there for this week on the revenue recognition and also the first 2 chapters of your text here, MBA fundamentals. So next time we'll look at the next 2 chapters, chapters 3 and 4 in this, and also we will look at the waste management case there, which will follow along really with what we're doing with revenue recognition. Of course, it's a different company with waste management, but that's all for now, and I hope you have a good day.